Welcome to the Sand to Pearls Stock Market Commentary video, your weekly window on stock market technical conditions for March 5th, 2017. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.46 was down slightly from 1.57 last week, continuing within bullish territory. The total count of securities in bullish or bearish patterns decreased fractionally to 3,172. The count of bearish stocks increased 4%, while the count of stocks in bullish patterns decreased 4%. The Sand to Pearls P&F Market Breadth Summary chart shows us a market now 16 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Sand to Pearls Stock Market Commentary via email free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 48 points for the seventh decline in 16 weeks. At a positive 306.51 points, it continues above the November 2014 top and the March 2015 top, but continues below the December 2016, April 2016, May 2016, and August 2016 tops above plus 100, as well as continuing above all five bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum, now at a positive 71.21, down from a positive 84.3 last week. We wait for the CCI 20 daily to return to the plus or minus 50 zone for a new trade. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 44 weeks ago, while the daily CCI 20 began a Woody's uptrend 15 weeks ago. The CCI 20 weekly has fallen to a positive 146.22 from 158.17 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and banking on top, gold and silver brokers on the bottom. Bullish, KBW Bank continues in the top 5. Comp Tech has entered the top 5. Gold and silver continues in the bottom 5. Bearish, brokers has entered the bottom 5. Oil and oil services have left the bottom 5. Focus this week from www.zerohedge.com. This is the only chart Americans should be worrying about right now. A few key points and the chart follow. In 2015, President Obama and Republican congressional leaders agreed to suspend the federal debt ceiling until March 15, 2017. After that date, less than 2 weeks from now, the Treasury will surpass its cumulative $20 trillion borrowing authority. So, with 2 weeks left until the debt ceiling suspension expires, Treasury's cash balance plummeted to $109 billion this week as of Thursday, making this the most important chart in the world right now. Once it hit zero, as Fiscal Times notes, newly ensconced Treasury Secretary Steven Mnuchin is expected to order emergency measures to effectively buy more time for the government to pay its creditors and cover revenue shortfalls to keep the government operating. The stakes couldn't be higher. Failure to raise the debt ceiling would do irreversible damage to the U.S. credit rating, trigger an uproar in U.S. and global markets, drive up the future cost of borrowing, postpone Social Security payments and tax returns, and force layoffs of non-essential government workers. Not everyone is ignoring the potential risks ahead. David Stockman dropped this reality bomb last week. Quote, "I think what people are missing is this date, March 15th, 2017. That's the day that this debt ceiling holiday that Obama and Boehner put together right before the last election in October of 2015. That holiday expires. The debt ceiling will freeze in at $20 trillion. It will then be law. It will be a hard stop. The Treasury will have roughly $200 billion in cash. We are burning cash at $75 billion a month rate. By summer, they will be out of cash. Then we will be in the mother of all debt ceiling crises. Everything will grind to a halt. I think we will have a government shutdown. There will not be Obamacare repeal and replace. There will be no tax cut. There will be no infrastructure stimulus. There will be just one giant fiscal bloodbath over a debt ceiling that has to be increased and no one wants to vote for." End quote. Stockman predicts very positive price moves for gold and silver as a result of the coming budget calamity. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.